afternoon, everyone. Happy Friday afternoon. I'm Lisa Donner, and I'm the Executive Director of Americans for Financial Reform, which is a coalition of more than 250 organizations working together to advocate for a financial system that does a better job of serving the real economy. I want to thank Senator Harkin and Representative DeFazio and the Progressive Caucus for sponsoring this briefing, our panelists very much for speaking, the AFL-CIO, the Center for Economic and Policy Research, the Communications Workers of America, and Public Citizen for putting together this event together with us, and all of you very much for being here. With the Congress and the country in the midst of a big important conversation about budgets and about revenues, we wanted to make sure that a Wall Street transaction tax, which is a tax that could both produce substantial revenue and have a salutary influence on the financial system, is a part of the conversation and on the table. We have an illustrious panel, and I'm going to introduce them extremely briefly, all four of them, and then ask each panelist to talk for 5 or 7 minutes, and then we'll open it up for questions and discussion after that. Jared Bernstein has been at the Center on Budget and Policy Priorities since May of 2011 as a senior fellow. From 2009 to 2011, he was the chief economist and economic advisor to Vice President Joe Biden, executive director of the White House Task Force on the Middle Class, and a member of President Obama's economic team. Jared's areas of expertise include federal and state economic and fiscal policies, income inequality and mobility, trends in employment and earnings, international comparisons, and the analysis of financial and housing markets. Wally Turbeville is a lawyer. He spent 12 years at Goldman Sachs as an investment banker, and then founded and ran a financial advisory and then a derivatives firm of his own. And since 2009, he's been working full-time on financial reform, including much writing and testifying before Congress, and he's now a senior fellow at Demos. David Borris is the founder and the owner of Hels Catering in Illinois, Northbrook, Illinois, the North Shore of Chicago. He and his wife originally opened a small food store in Highland Park in 1985, and over the years they expanded into a full-service catering business with about 25 full-time employees and 80 more part-time and seasonal workers. He's a member of 3 different local chambers of commerce and serves on the National Executive Committee of the Main Street Alliance Small Business Network. And finally, Damon Silvers, who's the Director of Policy and Special Counsel for the AFL-CIO, who also from 2008 to 2011 was the Deputy Chair of the Congressional Oversight Panel for TARP, and who's wrestled with the financial system and with its relationship to the real economy through his service on SEC and Treasury committees, including the SEC's Investor Advisory Committee, and invaluable articles and talks. Turn it over to Jared to begin.
Thank you very much, and I will be brief, try to stick to my 5 minutes because I'm actually very interested in my fellow panelists here. Less interested in what I have to say, although maybe you'll feel differently. Since I'm going first, I thought it made sense to start with what is it? A financial transaction tax. I suppose everybody in the room knows that, but just to make sure we're starting on the same page. It's a small tax on financial transactions, typically a fraction of a % on stock trades, bond trades, currency trades, derivative trades. And of course, the bill that's kind of at the heart of our discussion today by Senator Harkin and Representative DeFazio is a 0.03%. So that's 3 basis points if you like to talk about each hundredth of a % as a basis point, but that's an easy way to talk about it. 3 basis points of a security, so a stock or a bond, or a derivative, and those include options, futures, and I'm sure we'll hear more about those exotics from some of our colleagues here. But if you think about that, first contemplate a 3/100th of a % tax before, in this building, in this that building up there, wherever the Capitol is, there's a tremendous amount of freaking out about any tax on anything because of all the distortionary impacts that people worry about. Now, typically we worry less about those impacts when the magnitude of the tax gets small. Well, we're talking about 30 cents on a $1,000 trade. Certainly whatever elasticity is embedded in there in terms of a response to the tax, it's not likely to be daunting given a 3 basis point tax rate, but I'll say more about that in a second. If you think that this is an exotic idea that these members dreamed up out of the blue, that's not the case. In fact, many countries, many advanced economies with highly functional financial markets have FTTs, or financial transaction taxes. The UK's long had a one on stock trades in the in the London Stock Exchange, and that one amounts to 0.5%, though there are considerable exemptions on that. The politics strike me as somewhat uniquely aligned in favor. And I'll say specifically what I mean. It has to do with the fact that Europe is interested. For a long time, and I've been advocating, along with many of the people represented here and in this room, for an FTT. One of the arguments against it was, if we have an FTT here, traders will just go elsewhere. It's really not hard to take your trades anywhere else. But if it's more unified, if lots of different countries with lots of different markets have one, it's harder to evade that way, and that argument is diminished. I pulled a quote from the New York Times recently about people who support a financial transaction tax. An array of influential champions, including the leaders of France and Germany, and that includes Angela Merkel, who's not known as a wild-eyed radical, the billionaire philanthropists Bill Gates and George Soros, former Vice President Al Gore, Ralph Nader, Pope Benedict XVI, and the Archbishop of Canterbury. So that's a kind of an interesting portfolio. I want to quickly finish up by talking about some of the effects that economists, which is the hat that I bring to the analysis, think about in this context. Efficiency effects, the incidence, quick comparison to the White House's preferred financial tax, which is a financial fee on bank liabilities, and then a bit on upsides and downsides. Efficiency effects. The thing you hear most about in terms of improving the efficiency of markets, I suspect Wally will talk about it, he was telling me about an interesting paper he's working on this, has to do with reducing volatility. So if there's a tax, even a small one of this magnitude, on trades, you might expect to get fewer trades, particularly those that you don't really want to make that badly, such that you're discouraged by a 3 basis point tax. So why is that important? Why is it important to reduce volatility? What's wrong with volatility? Well, volatility tends to work against the thing that I learned capital markets were for. This may surprise you, because over the last, I don't know, 10 years at least, certainly over the last few years, capital markets have a really bad rap. Really bad rep, I guess you said. Really bad reputation. A really bad rep. And you know, in many ways deservedly so, because they're not fulfilling, in large part, they don't seem to be fulfilling the function that we were all taught, which is the allocation of productive capital to its best use. A society like ours often has excess savings, so you have a stock market that hopefully distributes those excess savings to its most productive use. But if there's a bunch of really high-frequency, volatile trades where one trader has an algorithm that beats another trader's by a nanosecond so that they can arbitrage a little price differential, that is not typically thought of as adding much value to the economy. And if you actually look at least the correlation between high volatility trading and the productive allocation of capital, you see it's quite negative. It looks like a lot of volatile trades with this kind of nanosecond arbitraging going on sloshing around sort of at the top of the economy, not adding much value. So in that sense, an FTT could add efficiency to the economy. Now there's another argument that says, in fact, it will do the opposite, because there'll be less trading and less liquidity, and therefore less price discovery. One of the things that also happens in financial markets that's good is that you can very quickly figure out what something is worth to a bunch of market players because of all the trading that's going on. It's just it can be a very good, clean way of discovering price. And if you diminish the liquidity, the amount of trading going on through a tax, you'll dampen this price discovery. Well, you know, I'm not so worried about that. I'm just going to give you one anecdote and then try to move on. I am a contributor to CNBC. Happy to be such. It's a challenge, but a good one. But if you've listened to the other day, I was on a segment where a bunch of traders were talking about how to trade the fiscal cliff. I can take you through it, but it was a lot of stuff like, well, when you want to go short when Boehner's speaking because he's negative, and then you want to go long when Obama's speaking because he's all I'm saying is it was patently nuts. And so that's kind of an offhanded way of saying I'm really quite suspicious that the notion of somehow a diminished volatility or fewer trades will dampen the price discovery. The incidence of a tax is very important. Whenever you're talking about a new tax, you have to think about who does it hit. The economic incidence is the question you want to ask. The statutory incidence is obvious. It falls on the people making the trades. But the actual economic incidence of the tax will fall on the traders, on the exchanges, on the companies, on the governments, who might face higher capital costs. It could fall on consumers for higher prices for financial services. We know very little about the incidence of an FTT. I think we have to be straight up about, at least I know, maybe my colleagues know more. But I do say this, and it's another anecdote. But sometimes, what do they say? The plural of anecdote is data. I have a friend who's a high-frequency trader. This is a guy who does those algorithms I was just talking about, you know. And he says if there's a financial, and this guy's a friend of mine, he's kind of a liberal. He says if there's a financial transaction tax, his firm will go out of business. And I think he may be right. That suggests that the incidence falls on traders. I don't mean to laugh at my friend. He's got a great, he's got a great thing going. I'm just saying, in terms of the incidence, the basic rule in economics is the incidence falls on the sector with the inelastic demand, the sector that can't get out from under the tax. So if you need cancer treatment and the price of cancer treatment goes up, you know, the incidence falls on you. If you're somebody who does high-frequency trading and you have a financial transaction tax, the incidence falls on you. And again, given my efficiency rap here, I'm not sure that's so problematic. I have some thoughts about the upsides and the downsides, but we can get to that during the discussion. Let me stop now and turn things over to my colleague.
Hi. Am I on? Am I on? My mic's been open all this time. Thank God I didn't say anything. I'd like to double down a little.
You'll do very well here.
Yes. In New York, with the red light, you do. I'd like to double down a little bit on what my colleague here has mentioned, and suggest that in fact the whole issue of liquidity and price discovery, when you look at the current structure of the marketplace, it's not that there's a lack of good contribution of liquidity or a lack of price discovery. It's that the way the markets trade right now, it's actually negative liquidity and negative price discovery as it exists. So that a transaction tax were it to affect the trading activities would actually be not just not negative, it would be greatly positive. The transaction taxes being talked about at the 3 basis points is a very small amount of money. When you look at, and I think a fair thing to do is to look at other costs of transactions that have been built into the system. Exchange fees, clearing fees, the fees that one incurs when if you go into an equity fund. You know, anywhere from a few basis points to 140 basis points has been delivered, has been elicited when looking at these amounts. So it's entirely possible that the actual effect on the markets will, in terms of trading activity, might not be so great. But it will, if it affects anybody, it's going to affect the people who are doing these high levels of transactions on an intraday basis, meaning they do transactions during the day. By the end of the day, they're flat, and so what their profit business model is to take money out during the day. You're going to hear from time to time people talk about it's going to kill liquidity and it's going to stifle innovation. But don't be confused between the concept of volume and the concept of liquidity. Those are 2 different things. The transactions that occur at high frequency during the day are not the kinds of transactions that provide reliable liquidity. Just go back to the flash crash in May of 2010. I had just left the businesses that Lisa mentioned. I was doing nothing but trying to lose weight and enjoy myself. So I was on a Stairmaster when I was watching CNBC, and when the flash crash occurred, and by the time I got off the Stairmaster, it was all finished. It was a great exercise routine. But what happened there is it's actually quite simple. Is a perturbation occurred in the market, so there were all these high-frequency traders, blasting away. They were probably providing some liquidity at the time. But when a little flaw occurred in the market, the algorithm that they were using flipped the switch. So what happened is that they instantaneously converted from liquidity providers to liquidity consumers. And upwards of $1 trillion later, and people figured out it was not a meaningful event that they were reacting to. Things corrected themselves. But what the claimed liquidity that a lot of this volume provides is worse than illusory, because it appears to be good liquidity until it's not. Now the flash, and when it's not, it becomes very detrimental to the markets. So the flash crash was a major event. The researchers tell us now, because they've gotten into it more, is that little flash crashes occur every day. So in terms of price discovery, providing liquidity to the market so it works well, it actually creates a market that's highly unreliable. And that market, that means that several things. It means that individuals and investors have fled the market since the flash crash, withdrawing money from equity funds. It means that institutional investors put a premium on their investments that it relates to the unreliability of the market going forward. So if the financial transaction tax were to have an effect on volume, that would not necessarily be a bad thing. Let's talk about where all this, and again, what are the markets supposed to do? The markets are supposed to make it very efficient for sources of capital to marry up with uses of capital. And that's called capital intermediation. And it turns out that can be measured. There's a terrific study done recently by a gentleman named Philippon from NYU. And what he discovered is, over a 140-year period, what he thought he was going to discover was that technology and quantitative analysis would cause the capital intermediation process to have become more efficient. In fact, it's become less efficient dramatically. What that means is that individual transactions might be cheap to do because the spread between buyers and sellers might be narrow, but something's going on in the market that causes that to be very inefficient. At the same time, the share of profits for the financial sector is somewhere around 30% of the entire profits of corporate America. That's up from about 15% pre-regulation. The share of GDP has risen from 4.2%, which is the average for the years the 60s and the 70s, to 8.3%. That amount of GDP increment is $635 billion a year. Compensation levels in the financial sector are at levels that are comparable to what they were just before the Great Depression. Now, what's going on is that there's this churn going on that has nothing to do with capital intermediation. I'm just going to throw out one more set of figures for you. At the end of World War II, the average holding period for shares of stock was 4 years. In the year 2000, the average holding period was 8 months. By 2008, it was 2 months. By 2011, I want you all to think, guess in your heads. The average holding period was 22 seconds. So what's happening is that the market is being systematically distorted, and those distortions are being sucked out of it. This pipeline, this capital intermediation pipeline, the market's being systematically distorted, sometimes very intentionally, sometimes it's just an observation, by the trading activity that's going on, the heavy trading activity that's going on. And what these numbers tell you is that amount has been sucked out at the level on GDP basis of $635 billion a year into the financial sector, away from building factories, bridges, away from and distorting the ability of the Fed to actually counter with monetary policy recessions. So what we're talking about now is the things that would be affected, if anything's affected by a financial transaction tax, would be those things that are actually distortive to the market and arguably cost the economy upwards of $635 billion a year. So that's from my perspective, were it to actually affect the markets, it would be a good thing. Thank you.
Oh, sorry, I forgot to say one important fact before, although we've been talking about the small magnitude of this tax, I was actually surprised to see the JCT score of the Harkin DeFazio bill as raising $350 billion over 10 years. So that's real money. And that's, by the way, that is a score, as JCP does, that's a score that includes behavioral response. So it builds in elasticities that would reflect, say, fewer trades.
So, good afternoon. Thanks for the opportunity to join you guys here today and to bring a brick and mortar small business perspective to this conversation. I've been a small business owner for over 25 years. My wife and I opened our business in 1985, Hels Catering. It had humble beginnings. We started with a few of my mom's favorite recipes, a catchy idea for a name, Hell's Kitchen. We named it for my mother, Helen, who actually helped us out as our opening chef for the first couple of years we were in business, as the first two of our three children were born. And a work ethic that often saw us at the store at 6 o'clock in the morning and not locking up until 9 or 10 o'clock at night. And like most startup small businesses, it was really difficult. But it was good, honest work, and it's turned out pretty well so far. I guess we had a good idea at the right time, the right place. People liked what we offered, and we gradually expanded from a gourmet retail carryout store to a full-service catering company. And we now employ 27 full-time employees and over 80 part-time and seasonal workers. And we take pride in what we do. We serve our community, we create jobs in a local economy. But since the onset of the financial crisis in 2008, small businesses like mine have faced a double squeeze. The first thing that happened is customer demand vanished into thin air. We're just now, in 2012, just now getting back to the top line revenues of 2008. And the bottom line revenues, that's probably going to take another year or two to get back to. So Main Street small businesses really took it. Our local economies and our customer base were decimated. Between March of 2008 and March of 2009, small business bankruptcies across the United States doubled. At the same time, with capital markets frozen, access to credit dried up for many small businesses. We've been fortunate enough to grow our business without the need for outside financing for many years now. But many, many small businesses, and especially the young startups, are not in that position and need capital to grow or launch, and couldn't get it because of the frozen credit markets. So customers and credit, together these make up the lifeblood of brick and mortar small businesses, and since 2008, they've been missing. So for customers, let's start with the customer side. How can the FTT help with the problem of weak demand in local economies? Well, they'll provide an alternative to the downward spiral of austerity economics. So much of the talk in Congress, right, has been about cuts, but we can't cut our way to prosperity. Europe tried austerity, and how well is it really working out for them? You know, as a small business entrepreneur, we understand that cutting is not the way to growth, right? It's not a long-term strategy. When we have some pressures on the revenue side, we might lay off a worker or two. You know, we might cut back just a little bit in investment, but we realize that that's a short-term thing that we do as we look toward how do we make investments to regrow the business. And in order to do that, we need the doorbell ringing, right? We need people walking through the door. Small businesses need customers. It's a problem of demand for us. We don't need more tax cuts and more budget cuts. The way to rebuild our local economies is to invest in infrastructure, invest in local jobs that bring paying customers into my business, not more cuts that undermine core infrastructure, that undermine basic services like education, job training, law enforcement. These sorts of misguided austerities simply reduce demand in our local economies. To build and grow for the future, we need to get back to a national conversation about investment, not austerity. Investment requires revenue. and the FTT puts a revenue on the table. You know, the revenue stream of all new taxes flowing into the federal government over the last 10 years now stands at the lowest level it has stood at in any 10-year period since the Second World War. This is not a problem of what's happening on the spending side. This is a problem on the revenue side, and the FTT can help with that for us. And on the other side of the equation, not only is the financial transaction tax a way to raise revenue, but it does it in a way that, as we were discussing earlier, that promotes productive long-term investment. Exactly what we need to encourage capital formation for small businesses. Wall Street and the financial markets have a critical role to play in capital formation for small businesses, for startup businesses, but over the past several years, we've seen Wall Street and the bigger banks drift away from this role. The explosion of high-frequency trading and the growing focus on proprietary trading have resulted in a declining focus on traditional, long-term, economically productive investment. And it's been bad news for small business lending. 22 seconds. That is unbelievable.
Go ahead.
Sorry. For the health of the brick and mortar economy, we need to turn that around. A financial transactions tax will help do that by raising the cost of speculative trading in the financial sector while barely touching traditional investors and small businesses like mine. So how will a financial transaction tax impact small businesses, brick and mortar small businesses like mine? And let me add that one of the things that we've chafed under, I think, as small business owners for the past couple of years is having our name taken in vain by Wall Street, by big banks, by big business, who want to talk about these job-killing problems with small increases for small businesses. The impact on me and my employees and my business will be absolutely negligible. My employees' annual contribution, the average annual contribution to their simple IRAs, which is our version in a small business of a 401k, is between $3,000 and $4,000, making a 3 basis point FTT cost to them, about $1. That's right, between 90 cents and $1.20 annually. It's not quite 10 cents a month. Even for myself and my wife, who are able to contribute considerably more to our simple IRA, the cost will be a little less than $10 a year, about 80 cents a month. And since the tax will be collected by and paid by the trading firms that hold our portfolios, there will be absolutely no additional paperwork for my staff to execute. Taken all together, it's obvious that the minuscule dollars to businesses like mine associated with an FTT like the one being proposed by the Harkin-DeFazio bill is more than worth the cost of a better functioning financial system that works for everyone, not just a select few. A financial transaction tax is an opportunity to raise revenue and level the playing field for small businesses at the same time. It's a good idea, and this is the right time and the right place. Thank you.
Well, good afternoon. I almost thought I was going to get away with being able to reveal the fact that this is a $350 billion item, but Jared stole my thunder. But it's worth repeating. So let me begin by saying that the AFL-CIO strongly supports a financial transactions tax, as do the labor movements of pretty much every country in the world. It is a key objective on a global basis of the world labor movement, and for all of the reasons you've heard from my fellow panelists, I know less of the details of other organizations, but I know that the FTT has also been endorsed by Americans for tax fairness, the major fair tax coalition backing an end to Bush tax cuts for the over $250,000 a year crowd. And I believe is supported by the other major labor organizations that are not affiliated with the AFL-CIO. And I think there are some representatives here who are confirming that in the room. Yep. Thumbs up at the back. There's a context here for this conversation, and my fellow panelists, I think, have given you a pretty good sense of both how this looks from the perspective of people who actually do invest capital to create value, and from the perspective of some very important issues around liquidity. I want to talk from the perspective of what I think is on the minds of most people in this room today, which is the fiscal debate that we are enmeshed in here in Washington. I think everyone knows that we are having a conversation about how to increase revenue and where exactly to do that. And some people think that we ought to not increase revenue, but rather cut vital government programs. I think everyone in this room probably knows, and if they haven't, we haven't been doing our job well enough, that the American labor movement has two very clear requests of the people that we elected to office here in Washington. And that is, one, that there should be absolutely under no circumstances any extension of the Bush tax cuts for those making over $250,000 past December 31st of this year. And that secondly, that there be no benefit cuts to Social Security, Medicare, or Medicaid. And in case anybody thinks that I'm being ambiguous, no means no, none. Now, we are having a conversation today in which there are people in both parties who are suggesting that America has become such an impoverished and depressed country that we can no longer afford what everyone knows is among the world's weakest systems of social insurance among all developed countries. That Medicare, Medicaid, and Social Security have become a luxury that is simply beyond us, unlike, say, during the fat, rich times when we founded these programs in the mid-1930s. The kinds of money that's being talked about as potentially being saved by perhaps cutting benefits in these programs is less than $100 billion. If you look at, for example, the President's budget in 2000 and the most recent budget the White House submitted, which includes some modest cuts to Medicare, those cuts are less than $100 billion in their 10-year budget window. The kinds of things that it appears that the Republicans are asking for in terms of cuts to Medicare, and these are, of course, the same folks who ran the ads saying that accusing their opponents of cutting Medicare. Now they're demanding cuts in Medicare. Never mind. The kinds of cuts they're asking for are in the $100 to $300 billion range over the 10-year budget window. We are talking here today about a 3 basis point tax on financial transactions that, according to the Joint Tax Committee, will raise $350 billion. Now, on the theory that no one is prepared to stand up in public and say that they think that cutting Medicare is just a good idea per se, like going to church on Sunday, that it's like just a good thing to cut Medicare. It seems to me that anyone who looks at this issue has got to explain why it's a better idea to cut Medicare than it is to enact a financial transactions tax. And this is particularly so when you understand that it is almost certainly the case that the Joint Tax Committee's numbers are a gross underestimate. And let me explain to you why that's so. As was alluded to by my fellow panelists, that revenue estimate makes assumptions about what kind of impact the financial transactions tax will have on market behavior. It makes assumptions about how many people are going to stop trading, and it makes assumptions about the extent to which there will be leakage. Now, the wonderful thing about the influence of the financial sector on our nation's politics is that it often enables people to take completely contradictory positions at the same time. For example, the position that somehow the burden of the financial transactions tax is going to fall on the average pensioner, $1 or so maybe, and at the same time that the financial transactions tax is going to create this vast cessation of financial transactions, which will lead the revenue numbers to be as low as, say, $350 billion over the 10-year window. Now, over in Europe, where they have a financial sector that is slightly smaller than ours, the European Commission is in the process of adopting a financial transactions tax. The European Commission has a tax department that is, shall we say, in terms of the scale of its resources, something more like the IRS than like the Joint Tax Committee. It's a giant bureaucracy with vast resources. And it did a study of the European Commission's proposal for a financial transactions tax. The European Commission proposal is different than the Harkin DeFazio bill, and it's also different than the other bill the AFL-CIO supports, Congressman Ellison's bill. But it's not that different. Instead of having one tax for all financial transactions, it separates them. It has a 10 basis point tax for stocks and bonds and a 1 basis point tax for derivatives. And for reasons I'm not going to go into, that's a sensible kind of rough kind of approach. But it's not that different in aggregate from 3 basis points for everything. And their study showed that in dollar terms in Europe, the first year of that tax raises $79 billion. The Joint Tax Committee prices revenue measures by assuming that over time they become more efficient at collecting the tax. So that there's an assumption both of growth with inflation in terms of revenue, and also an assumption about growth in overall effectiveness of raising the money. So that the 10-year budget number for a $79 billion tax in the revenue gain in the first year is over $800 billion. Right? If you assume for the moment that you get $79 billion in at the front end. And as I said a moment ago, the US capital markets are actually slightly larger than Europe's. So that the likely real number, in my opinion, for the FTT is probably, for the Harkin-DeFazio bill, is probably close to $1 trillion in the 10-year budget. Right? Now, but you don't have to believe that. You just believe JTC. And you're talking about one of the largest potential revenue-raising mechanisms available. And it is actually superior in terms of economic impact to ending the Bush tax cuts on the rich. Because the Bush tax cuts on the rich are actually taxes on income. Right? And this is not. Now, having laid out the seriousness of the revenue implications here, particularly in the context where people are running around and saying we need to take health care away from the elderly because we don't have enough money. And I mean, maybe I understand why Lloyd Blankfein might feel it would be a better idea to take health care away from the elderly than to have pass a financial transactions tax, but it's not clear why any other American should feel that way. Now, there are two other points to be made about this that have not been made so far. And one is a point about fairness. Because I have news for you. We already have asset transactions taxes in this country. And they are not 3 basis points. They are a lot more. It is actually true, it's a factual matter, that most Americans have only 2 capital assets of any consequence. And neither of them are subject to the financial transactions tax, but they are subject to transactions taxes every time they are bought and sold. And one of them is their house, and the other is their car. And increasingly in communities of color, there's only one, and that's the car. And the taxes on those assets are very large. We have a deeply regressive and deeply unfair asset transaction tax system in the United States. I can't quote you what the rates are on the taxes on selling a car and on selling a house, but it's not 3 basis points. It's not 3 basis points in any state in this country. Most of us have paid more most of us sort of our age, have already paid more in asset transactions taxes as a result of the system we have today than we would ever pay under a financial transactions tax. And finally, a point about evasion. You hear a lot about evasion. One point, and one aspect of why this is not to be taken too seriously has already been made, which is that the European Union is already moving toward a financial transactions tax. Various types of financial transactions taxes already exist in Asian capital markets and in London. But there are 2 other things to be aware of in relation to the evasion issue. The first is that the financial transactions are about the easiest thing to track and enforce of any kind of thing that we tax. Every financial transaction is run through every financial transactions tax is either run through a centralized clearinghouse of some kind or is conducted between large, heavily regulated institutions with public accounting firms looking over them and regulators and all that sort of stuff. There are no secret financial transactions, and as far as I know, there are no financial transactions of any consequence that are conducted in cash. All right? Now, contrast that, for example, with the sales tax. Right? We still buy and sell things for cash, I believe, right? Your place of business, right? We collect sales taxes. Nobody seems to feel that that's somehow, a utopian fantasy that we can collect sales taxes, and yet that's in cash. Right? Income taxes, a lot of people, it's kind of the honor system, really, particularly given what we've done to the IRS. Financial transaction tax would not be. Evasion would be almost impossible if any serious effort was made to prevent it. And not only that, but if we were worried about transactions leaving this country, there are a variety of ways of making that extremely difficult. My favorite one, and again, it's simply a matter of will. Are we serious about collecting the taxes or not? If we're pretending, then I suppose that we'll make lots of loopholes. But if we're serious, there's a simple system, which is you need to have a little check mark by the record of your financial transaction, or which shows that you paid the tax. or your transaction is not enforceable in U.S. courts, nor is any judgment based on your transaction collectible in the U.S. courts. I think we very quickly determine who really wants to play the game of running away from the United States and who doesn't. Now, so I want to close by, again, reiterating that in the moment we are in Washington, right, the labor movement believes that not only is a financial transaction tax good in terms of capital allocation, and that $600 billion number is the first price I've heard put on the fact. And again, some of this stuff can be very complicated if you're not, a financial guru. But think about it this way. Not all savings is investment. Not all uses of savings is investment. Sometimes some of us have been known to save a few $100s and go to Las Vegas. Play blackjack, you gotta have money in your pocket. You can't have money enough for just one hand. Right? If you want to play the blackjack game, you gotta have money for more than one hand. Carry that money in your pocket. That's savings. It's not investment. Right? It's not investment. High-speed trading is nothing more than people playing blackjack with various kinds of edges against the house or against the other players, and having money in their pocket to fund the game. The money in your pocket is not 10, 20, or 50 bucks. It's hundreds of billions of dollars that we desperately need for productive investment in our private sector. Right. And so in the context that we're talking about, a financial transactions tax not only has these positive externalities, but it seems to us in the labor movement that it's really profoundly immoral to talk about things like cutting Medicare, right, when this policy measure sits in front of us, able to raise far more money than in reality in our political process we are ever likely to get by taking medicine away from our grandparents. Thank you.
Thanks. So let's open the floor
to questions. If people would say their name and where they're from before they ask their question, that would be great. Go ahead.
Hi, my name is Alicia Saratani. I work with the Executive Intelligence Review magazine. I'd like to play a little bit of devil's advocate. The figure of $350 billion is being thrown around is an approximation of what we could get off of this tax. But I think it's fair to say that not all money is created equal. $350 billion spent in investing in the nation's infrastructure is very different than $350 billion, invested in what goes on in Wall Street every day. It's a different quality, does different work. And a good example of that is LIBOR, which never really was actually dealt with in the transatlantic, among the transatlantic nations. And we saw that, rate fixing, as it translated down into federal and state and city economies, this was taking far more than millions, above billions. This was cumulatively taking over $1 trillion from the domestic budgets of nations and states and cities. So we can tax, Wall Street and the City of London and these things, but I don't see at the end of the day how this tax on this kind of money, these capital flows, even holds a flame to the just downright usurious nature of the system. And I'd like to get your thoughts on actual full reorganization, as was been proposed with Glass-Steagall. I know Marcy Kaptur has HR 49 in the House. It's a bipartisan bill. I hope this isn't being discussed as an alternative to that. Maybe we can regulate these guys. We saw with LIBOR, we see on a daily basis, this is a usurious system. And I think something like Glass-Steagall needs to happen. And then this tax is very appropriate, it's a great revenue.
Thank you. That's a great provocative question, and it's always good to have somebody playing devil's advocate. My sense is one that's probably more pragmatic, or maybe too pragmatic to satisfy the urgency and some of the very real concerns in your question. I don't see a massive restructuring of financial systems or financial markets in any way that strikes at the heart of usury, kind of in the spirit of your question, I would surely hope that we could figure out how to calculate a LIBOR that isn't corrupt. That seems to be a very low bar. But when it comes to actually generating revenue from financial markets, I think we're probably looking at something in the ballpark of what we're talking about here. The White House, for years, actually has resisted a financial transaction tax, preferring instead something they call a financial liabilities fee. So, you know, from your perspective, this is just nibbling around the edges, but you know, that's where even this edge nibbling, you know, if you kind of listen to Damon, and I liked a lot of what he said, you know, it doesn't sound like nibbling from his perspective, and you know, and I agree. So you know, even this, even the changes of magnitude we're talking about have been quite hard to get over the hump. As I said, the White House had a financial fee that I think raises like something in the neighborhood of $100 billion over 10 years. Right. So that's, you know, that's even a third more nibbling than this. And by the way, that hasn't gotten anywhere. So it's not like Congress is saying, oh, okay, well we'll just take that. I think the attributes that you heard from the panelists of the FTT make it a strong candidate, and you know, don't let the good be the enemy of the best.
Yeah. Can I just say that the AFL-CIO supports a restoration of Glass-Steagall. We don't see one as being a substitute for the other.
And if you think about what edges we're nibbling here, the edges we're nibbling are the kind of financial activity that that's enabled by the oligopolistic structure of the banking system, and none of this occurs. I mentioned the figure of 635 billion in terms of GDP. None of this occurs without an interaction between the high-tech side of banking, which enables you to get in and out very fast, to know what's going on, to use pattern recognition software of the highest form in Cray computers to figure out who's doing what to whom in the markets. But you also have to have an oligopolistic banking system in order to take advantage of that. So these things are interrelated, and again, what this particular transaction tax would do would have a disproportionate effect to those kinds of transactions that are the least productive from a capital standpoint.
I would only add that, you know, for our coalition of small businesses, yeah, we would love to see Glass-Steagall put back in place. What we're after is banks getting back in the business where it's advantageous for them to invest in our ideas and our growth, and less advantageous for them to take that money to the casino.
I'm Bob Feinberg, and I am the member of Republican for Financial Reform. And I'm not going to make a speech, but I think I have an argument that I'm surprised that we haven't made yet, which is that administering this whole system costs money in terms of regulation. And if someone doesn't pay for it, especially when it entails systemic risk, then it's externalized by financial systems. And some estimate of that cost should be made and split up among everyone who's a user. It's basically a user fee. So I would think that that would be part of your talking points.
Can I just say in response to that, that is a very good point. And I'm somewhat embarrassed that none of us thought of it. But it can be expanded from there. In a couple different ways, because in reality, although we do spend a great deal of money regulating the financial system, we don't spend, I don't think, the kind of money that a financial transaction tax can raise. Right? It raises a great deal more than the cost of regulating the financial system. Now, I would suggest that one of the first uses we ought to put to it is to do things like make sure that the SEC has at least as good computers as Goldman Sachs does. But that's, you know, and that I think does also lead to a broader point about the fact that while Congress insists on having an austerity kind of focused discussion right now on fiscal policy, a key need in terms of the long-run uses of the proceeds that we're talking about for the financial transactions tax has to do with the kind of public investment my fellow panelists were addressing. But there's a deeper sense in which I think the questioner's point is well taken. The Bank of England estimates that the financial crisis we've just been through cost the world economy $60 trillion. An unimaginable sum. The GDP of the United States, everything, the value of everything everyone does in America in a total year is $14 trillion. Right? So you're talking about, you know, more than 4 years worth of the entire activity of every person in America wiped out by the financial crisis. A financial transactions tax you could think of as kind of an insurance premium in a sense against the likelihood that massive government action will be needed to rescue this system, and kind of a compensatory device in terms of the lost capital that should have been put to productive purposes. I mean, these are much larger scale concerns, but I think at a minimum the questioner's point is spot on. Right? And is already the basis for very tiny financial transactions taxes in the U.S. system today. Initial securities issuances are the subject of a financial transactions tax today in the United States to fund the Securities and Exchange Commission.
Let me tell you a story. The knock-on effect of the financial transaction tax is important here. Putting the banking system back into the business of capital, raising capital for like real businesses and real enterprises and real governments is a very important thing. I ran a company that was was founded on the notion that, this was back in 2001 when I started it, that derivatives could be a dangerous thing, which everybody laughed at the time. And the idea was to manage risks in derivatives for the energy markets. I went to the gentleman in charge of energy sector of one of the largest banks in the world that comes from Europe and starts with a D. And I said to him, I got this terrific idea. Instead of having your derivatives desk extend credit to every one of your energy customers and consume that credit capacity, which is the amount they can loan to these energy customers to build power plants, to build transmission lines, to build everything else energy folks do. Take the credit capacity that's allocated to your derivatives desk, give it back to the energy group, let the energy companies borrow money from you in a straight up loan, and go through my company, which I can make things much more efficient and much safer for the banks and for everybody else. The derivatives desk said, oh no, we can't do that. And the question is why? And the answer was, if we deploy credit capacity through the derivatives desk, we earn 10 times more than if we deploy credit capacity through conventional loans. 10 times more. So what that's telling you is that all of these things that we're trying to, that will have some beneficial effect of the financial transaction tax, all this behavior that you're trying to change is vastly more profitable than lending money to Detroit Edison to upgrade its system so that energy is used more efficiently. So that's an important part of this, is to change behaviors throughout the system by taxing what are valuable transactions for the banks, but not valuable transactions for the economy as a whole.
Let me very briefly speak to your question as well. I didn't get to my list of upsides, but it actually was there. I see the upsides, and then I want to make a comment about my colleagues' comments here. I see the upsides of an FTT as reducing volatility, improving capital allocation, reducing the distorted size of the sector, as Wally was saying. I think it's overgrown its britches. collecting revenue, and as you suggested, as Bob suggested, correcting for negative externalities, which is huge. Now, the thing is I wouldn't, on the other hand, I wouldn't put as much weight on a financial transaction tax to be as corrective as perhaps Wally and Damon suggested. I don't think that it would really work very well as an insurance policy against the kind of meltdown we just had. I think it probably would help by reducing volatility and high frequency, the high frequency kind of instability, flash crash stuff. But for that, to really have a system that's more self-insured, you need much higher capital reserves. And that's a different policy. In other words, banks have to have enough capital, and I think the story Wally just told you actually underscores this point, which is that it's by dint of leveraging up 30, 40, 50, 60 to 1 that these folks were making such obscene profits. So I don't want to put too much weight on the back of an FTT. I think it's a great idea for the reasons we've said, but I don't think it fixes it obviates the need for something like much deeper capital reserves.
And I don't either. That wasn't what I was making. It's funny. The insurance policy statement I made was actually sort of more literal than most people are used to. Right? The typical use of the term insurance policy suggests it has some kind of mitigating effect of the risk. All I'm saying is that governments seem to have to outlay seem to have to lay out on occasion a fair amount of money to deal with messes the financial sector makes, and that a financial transactions tax at least reverses the flow for a little while. Anyway.
Other questions? Well, it's very extraordinarily punctual of the crowd and the speakers. Do people have any last comments they want to make?